What's going on, guys, and welcome back to another video. So in today's video we're going to do something a little different, as yesterday I got a request to go through the steps I would take if I was beginning to invest in the stock market again. So it's more of like a how-to video, how to invest in the stock market. So in my opinion, there are 6 key factors that you need to consider before you start risking your own capital. But as always, if you're new around here, please consider subscribing to this channel, as our next target is 300 subscribers. So with that being said, let's dive right into today's video. So the first thing you need to consider is what kind of trading style you want to undertake. Now there's 3 main forms. There's day trading, swing trading, and long-term investor. With day trading, it can be quite volatile and the success rate is quite low over the long term, as the market always has the upper hand. So I don't really day trade as such. I would be kind of more focused towards the swing trader and long-term investor, and especially as a beginner, you don't really want to dabble too much in day trading because you can blow up your account within a matter of days or even one day. In terms of swing trading, this is buying positions or selling positions within a time frame of, let's say, 3 days to 3 weeks. Again, that time frame is optional, but that's kind of buying, let's say, a company like Tesla. If you think there's a catalyst coming out in the coming days, then you might want to buy now, and then once the catalyst comes out and the price is reflected in the share price, then you'd want to kind of sell it off quickly enough. That's kind of swing trading. But in terms of my own investing, I'm a long-term investor. As slow and steady does win the race in the long term, you need to ensure that when you're long-term investing, that you take a lot of factors into consideration. It's not just throwing a dart at a dartboard and thinking you're going to make money every time. It's not. So we're going to go through the list of tasks that I go through myself when deciding on trades. So the first things you need to consider are your time frame and age. So obviously someone in their early 20s or even 30s would have a lot better risk appetite, let's say, than someone that's going to be retiring in a few years. So when you're younger, you can obviously afford to risk a lot more because you have more time to recoup the losses if something did happen. Whereas if you're, let's say, coming up to retirement, you need to ensure that your money is held safe. So for that case, you wouldn't be becoming a day trader as such. You'd be kind of still, even though you wouldn't have many years left to be investing, you would be more of a long-term investor, as that would be more safe in kind of blue chip companies. Now the second point that I just covered as well was the attitude to risk. Even if you are young or old, people have different attitudes to risk. Some are risk adverse, some love risk, as risk does give a lot of reward, but it also has a lot of downside. Like there's a risk reward ratio that you need to consider when investing in any company. So you shouldn't obviously risk capital that you can't afford to lose. So that would also play in a factor that I have later on in this slide show is emotions, but we'll come to that later on. So you need to understand what your risk is to investing. If you have a lot of risk appetite, then maybe day trading would be for you. But again, it has a lot of upside, but it has a lot of downside as well. If you don't really like too much risk, you can start investing in things such as ETFs. Like I made a video on that yesterday, so I could put that in the description below. That's fairly safe bet going forward, and there's not a lot of risk involved in that. You need to realize what your current personal situation is. So you need to decide, like if you have money, if for example, my own personal situation, I might be going for a mortgage in a few years, and if you're getting married, if you had kids or whatever, you wouldn't have a lot of extra additional money to be spending or investing as such. So you need to consider how much you actually have to invest as well. You shouldn't be putting in money that you can't afford to lose. So that's what another rule you need to kind of consider before you do anything at all, is seeing how much capital you can start with. And again, you can start with as little as $50 to invest. It's just the main thing is that you start investing as it builds up over time through compound interest. And the fourth factor you need to consider is if you want to go through the dividend or growth investing, or you can even do both, which most people actually do. So like a growth stock would be a company such as Apple or Tesla, and a dividend stock would be such as Coca-Cola. So with dividend stocks like Coca-Cola, they don't tend to fluctuate too much in price over the long term. They might go up $1 or down $1 every few months. But what people invest in these companies for is because they're safe blue chip companies and they pay an annual dividend as well. So again, if you only have 1 or 2 shares, the dividends mightn't seem a lot, but as you continually buy shares over the years, you'd be surprised how much of a dividends you will start to recoup, and you can start compounding this back in for more interest as well going forward. Now with growth stocks, they don't pay dividends as such, usually, and that's because they reinvest their money into the company. They're trying to get the share price up as fast and as high as they can over a certain time frame. So they would be more speculative, kind of risky stocks. But you can also buy some growth stocks that are a lot more risky than others, such as, for example, I currently have shares in Workhorse. Now, they're not a blue chip stock by any means, but they have a lot of upward potential. And again, they could just as well crash tomorrow. But if you want to kind of pick some blue chip growth stocks, it'd be more the Apples or the Amazons or even the Googles of the investment world. So once you've decided what kind of trader you want to become, be it day trading, swing trading, or long-term investing, and you went through the factors as well that I considered, such as your risk appetite, age, current situation, etc., you then need to go ahead and pick a broker that you want to invest with. Now personally, again, there's no affiliate links here at all, but I use Trading 212 and Degiro due to being little to no commission on these, as my account, as you can see here, is only about 3,300 euro, so I wouldn't be getting into the big brokers as such yet because the commission would eat up all the profits. But personally, I use Trading 212 and Degiro, and I made a video yesterday on these two brokers. Again, I will link that in the description below. But I use Trading 212 because there is no commissions at all, so you can buy and sell as much as you want without paying any fees. And then I use Degiro. Well, I haven't used it in a while, but I'll be going back to it again because they have went from having 20,000 euro consumer protection and it's now gone up to 100,000 euro. So I'm going to be actually putting more capital into this broker again going forward. The only difference that I find between these two brokers is that you have to pay a 50-cent charge for every time you buy or sell companies on this platform. That's kind of the only downside, but again, that's still very cheap in comparison to a lot of other brokers that you need to pay, like, let's say $5 to $10 every time you buy or sell a company. Now, another thing you need to understand as well is that even after you pick a broker and you've after investing capital, and you could have bought some companies at this stage, you still need to continually do your own research and due diligence, as the markets are always changing and there's ever-present opportunities arising across the board, across all different sectors. Now, tools that I use as such, especially Yahoo Finance, is a great tool and is a very reliable source of information as well. Investopedia is a great tool and platform to look at also if you need to learn something or you need to understand what something means. Dividend.com is very handy to know as well for when you're looking up companies' dividends, as it gives an accurate reading of their overall dividend payout, their frequency, etc. MarketWatch is another one that I use the odd time. That's also very handy to use. And you should also start looking at books and online videos to help further increase your knowledge of the stock market. And again, I do not advise you buy any courses from anyone, as you don't need to do that. You could much better off using that money to invest into your own portfolio. So do your own research and actually take the time to learn the stock market. Another key factor that you need to control is your emotions in the market. So you need to keep your emotions out of the market. A good book that I've read, and in fact you can actually get the audiobook for free on YouTube, I think, is Trading in the Zone by Mark Douglas. Now, it's quite a dense, comprehensive book, but it's brilliant, and it shows exactly what you need to know about emotions and how they affect the market and how they can actually help you succeed if you learn how to control them. Now, as the markets are cyclical, you need to realize that they always move up and they'll come back down. So if your account is in the red, which we'll go into in the next slide, you need to dollar cost average. So when I see my positions in the red, I'm actually quite happy, as weird as that sounds, because it means I can actually buy more and sort out my dollar cost averaging and to make sure it's even better. As long term, I know once you do your own due diligence and once you mainly can invest in blue chip companies, that over time they're going to go back in an upward trajectory. So as I just mentioned, that in order to be a successful long-term investor, you need to realize when there's opportunities and to buy when the stock price is down. Now, as I mentioned, that markets are cyclical, and here's an example of Bank of America. And again, I know it's only on the 5-day time frame, but this is just for example purposes. Like you can see the markets, they go up and they also go down. So they went up a good bit here. So then if you let your emotions get ahead of you, so once it got to say the 24, 28 mark and it crashed down a bit, then a lot of people, if you had your emotions in control, you'd have sold here in panic and you'd have actually probably lost money. But in fact, if you did realize and kept your emotions out of the market, that markets go up as well as down, you would have realized after a few more days that it would have gone back up again. Now this is just a brief, very vague example, but you can see that they go up and down all the time, and over the long term they have higher highs and even higher lows as well. So you need to take that in consideration, and if you can control your emotions and realize this, you would definitely go far as a long-term investor. So with all that being said, guys, that brings the end to today's video. So in summary, we went through what trading style you need to become. So if you want to become a day trader, swing trader, or long-term investor. We went into the factors to consider, so the time frame, age, your attitude to risk, current personal situation, and if you want to become a dividend or a growth investor. Then we went into brokers. So I currently use Trading212 and Degiro. Again, I like both of these brokers, so it's up to you which one you pick, or you could even pick one that's not one of those two. Again, it's completely up to yourself. Next, I was talking about the importance of research. So a list of companies down below that there, the companies that I use to do my own research and to kind of analyze stocks going forward. Emotions, I talked about the importance of keeping your emotions out of the market, as the markets are cyclical and they will always move up and down. And finally, we went into talking about dollar cost averaging and always buying on the dip to help improve your dollar cost average and over the long term further increase your profit. So with that being said, I hope this video helped you out a bit, and if it did, please consider smashing that like button, and again, if you're new around here, please consider subscribing to this channel, as it would really help this channel out going forward. And if you have anything to note in the comment section below, if you think I missed anything, or if you'd like to add anything in, or again, if you have any questions on what I went through, please don't hesitate to comment below, and I will get back to you as soon as possible. Thanks very much, guys, and I'll see you all in the next video.